Ladies and gentlemen, listen to what Tom Lee just said in this clip today on CNBC that should have everyone paying very close attention.
It's here bringing Tom Lee here at Post 9, of course, Fundstrat Global Advisors, co-founder, managing partner, head of research, S&P target for year-end 6,300. Great to see you, Tom.
Great to see you.
You like to call them granny shots, easy plays. In your view, I have to imagine that list has gotten longer.
Yes. It is, but it stayed around 35 names, but just high quality names that are in the right sort of themes. We have 7 themes, and as long as they're in more than one theme, they become a granny shot.
Higher conviction on those names, I imagine.
Yes, higher conviction, and these are names that I think most people are going to be familiar with because they're large cap stocks.
There's some discussion about cyclicals today, that they make sense, and a lot of people are looking to 2016 for analogs, but some argue that there's not the commodity price support that you might have had in a prior cycle. You buy that?
You don't necessarily need commodity prices to help cyclicals.
Yeah, energy, but even materials to some degree. Some are.
Yes, that's right. Yes, so for those, I would say yes. I'd say the outlook for energy stocks isn't great, as good as people might expect under a Trump presidency, just because expanded drilling is lower oil prices. But for cyclicals like industrials and financials, this is, for all the things you guys were discussing, a great environment, including M&A and cost of money falling and animal spirits and deregulation.
Do you think there is real reflation risk in the next, say, 6 months?
That is something that we can see how markets are repricing, and there's a measure called 1-year inflation 1 year forward. So what does markets think 1 year inflation is a year from now? That has been creeping up. It's actually now at 3.6. It's been a trigger point in the past where the market starts to worry. So whether it's the deportation that's causing that, or fiscal spending, I'm not sure, but it is, markets are starting to think about it.
Or more of just better growth outlook could help inflation expectations rise. I guess where Trump trade 1.0 ran into trouble was around trade policy. And once we see what he delivers there in terms of tariffs, something he's been very, very consistent on. Do you think the market is looking past that, or everything else, the deregulation, the lower corporate taxes, is going to offset any weakness on trade?
I think that if someone was trying to paint a negative picture, that's the tariffs and the trade is what's on people's minds. But of course, that's the one where we don't know what the ultimate sort of policies will be. I'm sure markets will actually provide a lot of real-time feedback, and I think that's going to help shape what the policy is. So I think in general, we should expect a pro-business environment, one that's probably equity-friendly as well.
Where are we on fundamentals and just, in terms of this recent rally, in terms of multiples and your expectations on earnings as we head into next year?
Earnings season, I think actually, as we're wrapping up, is still been very solid. As you know, the drag on earnings has been energy and some of the commodity groups as well as healthcare. But, groups like industrials and tech are still producing good numbers. I think next year the outlook should be good because cost of money is coming down and we're seeing housing activity pick up. And if there's mergers, this is actually much better for small caps, and small cap earnings growth has been around 40%. So I think it still sort of guides us to the same trades, which is we want to be more cyclical over the next 6 months, and then also look at things like small caps and Bitcoin.
Small caps, why mergers? Just give me a little bit more on why small caps are going to be a bigger beneficiary.
Well, part of it is the backdrop. Small caps have underperformed for the last 5 years by really the largest margin in 25 years. They're now trading at 10 times median PE relative, and for the S&P that's almost 18 times, so a 7 PE discount. Small cap earnings growth is faster, and not only that, but roughly 44% of it is what I'd call very cyclical, and that's things like regional banks and industrials. That's a bigger weight than in the S&P. And then finally, there's a lot of cash on the sidelines, and I think if people are looking for breadth expansion, that's small caps.
Well, they also don't have the trade exposure. They get the benefit from lower taxes and regulation.
Yeah, that's a good point.
Without the tariffs also, so it feels like they're in the sweet spot.
That's right, and the margin of outperformance could be sizable. They've underperformed by almost 100 percentage points, so I think you could recover that over the next few years.
We were mentioning Elon Musk a moment ago, and over the weekend, he endorsed this notion from Senator Lee about end the Fed, essentially. Journal over the weekend with the piece about Powell preparing or being ready to defend a removal if, in fact, he's asked to leave. Do you think the bond market would revolt at any kind of attempts to influence the Fed or re-executivize the Fed?
Yeah, I mean, absolutely. I mean, the Fed is the most powerful entity in the world, and part of it is its independence, and it's something that even the bond market is scared of. I think changing the structure of the central bank would be not good for capital markets.
Now, if you missed what Tom Lee said, the significance of it, let me give you an explanation. Tom Lee said that Trump's tariff policies are not going to negatively impact the markets, that you are going to see a favorable business environment for business. That's great news for stocks. Now, specifically what you should pay attention to is what Tom Lee said, as I have been saying. Trump is basically going to fish. This is like fishing. You throw out policy ideas, see how the markets react to it. Some policies the markets are really not going to like. Some policies the markets may not care about. And if you're Trump, your goal is not to crash the stock market. For someone like Trump that judged his presidency upon the stock market's performance, that makes a lot of sense. He's not going to do these policies that are going to negatively impact the economy and the markets. That's just not on the table here. But that's kind of what Wall Street has come to expect. Now, in recent days, in the last week or so, you have seen Wall Street open up to the idea that maybe the tariffs won't be so bad, maybe economic activity will be good. It's a wild card on inflation, what that's going to do. Wall Street's break-evens, as Tom Lee said, are still trending higher, so markets are generally still expecting more inflation. I don't think that is actually what we're going to get, and I think Wall Street is wrong in assuming that. Now, these things will take some time to play out, but anytime now we'll start getting policy updates. What tariffs could look like, so on and so forth, and that is going to be probably the biggest driver to move markets. But as Tom Lee said, market participants are really getting excited over the potential of M&A activity, less regulation. These things are very positive for business. Not to mention lowering the corporate tax rate could go hand in hand with boosting profitability and make some of our estimates for 2025 easier to obtain than maybe they otherwise would have been. Now, Tom Lee is not budging from the stance of favoring small caps, and I think he makes a pretty good argument there, especially considering small caps, they're really not as affected by a potential tariff policy change, right? A lot of small caps do business in America. They're usually not multinational conglomerates, okay? So likely that index would have less effect from the tariffs. But I really see this as a potential tailwind for the markets, a tail. The economy in this book, he mentions the economy is really driven by tail events, okay? Like World War II and the boom that followed that in the manufacturing sector. Nobody could have forecasted that. At the time, there were fears about another depression coming after the war because there was 8 million soldiers coming home over the 18-month period following the war. And there was really no jobs for them. All the factories were converted to wartime efforts, so the economy kind of had to start over fresh. There were a lot of fears, but that turned into a 75-year boom for the economy. That was one tail event that caused 75 years of gains for markets. Now, obviously, there were other things along the lines, but that was really a big changing factor. That is a tail. That is a tail. Some people call it a tail risk, a tail event for markets. As the markets are expecting all of this negative policy in the form of tariffs, if we don't get that, in fact, if we get almost a perfect business condition in the US economy for business to take place, that could be a big tail for the economy, at least in the intermediate term. Is this rewriting the business cycle? Probably not. Is this huge? Could be, but maybe not. But I think it's substantial enough to be a big surprise to Wall Street and push stocks higher. Again, specifically with small caps, there's a lot to like about that area, as well as that cyclicals. Look at something, I love looking at this one. Dollar General. Dollar General really measures the broader economy, incorporating everyone. It incorporates lower income, middle income, higher income. Everyone shops at Dollar General. Dollar General stock has not done well, even during this whole Trump rally. That's what I'm looking at here to say, are we pricing in too much? Are markets getting too euphoric? I don't think markets have gotten too euphoric until some of your deep cyclical trades start to do really well. And I think that will ultimately happen over the coming months. And that just tells me we could have quite a bit of time here for this rally to continue higher. Now, what's actually interesting is look at the S&P today. The S&P was up 0.1% in regular trading and was down 0.1% in after hours trading. But if you're a stock picker, your portfolio was up a lot today. Okay, big tech really got wrecked. Nvidia down 1.6%, Apple down 1.2%, Meta down 1%, Amazon down 0.5%. Google was the only positive one, up 1.2%. Microsoft down 1%. These are big losses for your big tech names. Tesla, on the other hand, was up 12%, including the move in after hours. Bitcoin continues to soar, currently at about $89,000. Look at the RSP. The equal weight S&P was up 0.5% today, even continuing higher in after hours. So what happened? Well, as I've said here on this channel many times before, the broadening out is happening. The markets are broadening. The rally is incorporating the broader markets. And I've expected this to happen for a while, and it's happening exactly as I expected. Exactly as I have forecasted here on this channel. Big tech is selling off, as I expected, as probably you expected. And the rest of the markets are moving higher. If you called this one, your portfolio is loving it. Look at Square, look at PayPal, look at CRISPR, look at really most of your high risk, high reward kind of stocks, small caps, things of that nature, did very, very well today. You can see today the Russell 2000 was up 1.47%, and the Dow was up 1.69%. The S&P up 0.1%, and the NASDAQ up 0.06%. This is actually healthy. You're seeing a broadening out, a more risk on kind of environment. This is healthy relative to the Mag 7 really carrying markets higher, and everything else left to kind of fend for itself. Valuations have gotten mismatched, if you will. Big tech that's slower growing than a lot of other stocks that we're talking about in the Russell, for an example, that are growing a lot more. Like, that shouldn't be happening. Why is Apple, that's grown revenue 5% in 3 years, trade at a higher multiple than something like a PayPal that's growing faster than that? It's doing 5+% per year. That probably shouldn't have happened to begin with. You are seeing a correction of what should have already happened, but it's starting to happen at a more aggressive pace. And that's why you're seeing this more in your brokerage accounts. With that said, the percent of stocks currently trading above their 50-day moving average definitely had another great day today, hitting 67.78%, up 0.5% today. CNN's Fear and Greed Index, let's give this a second to load, is coming in today at a whopping 68. Okay, you are on the high end of greed, but you don't get to extreme greed until you're at 75. And then once you're in extreme greed in like the 80s, that's where things start to kind of peak out a bit. But if we just get selling in big tech and a broadening out of the rest of the markets, you don't have to see a lot of greed necessarily come into the markets, right? That's, again, kind of correcting what should have already been corrected. And that's one reason why I'm bullish from now into year end. You're kind of in a sweet spot before you're getting some of these policies being announced, where markets are kind of just going with their own expectations that maybe things won't be as bad as feared. And ultimately, we'll see it's going to be a lot of fishing behavior activity where Trump's going to talk about a policy, markets are going to react, and then he's probably going to not talk about that policy anymore. Right. So I think there's a lot of high expectations for what tariffs could look like. If we are pleasantly surprised, let's say it's solar tariffs, or let's say it's car tariffs. That's not too bad. That's not bad at all. Okay. That sounds good to the American people. Like, hey, we're not going to buy China made cars anymore, or companies that, get their parts from China. Does that really have that big of an economic impact? No. It doesn't. Barely any. Like, it's almost immeasurable. Okay. Look at Tesla. If you buy any Tesla, if you own a Tesla, it was not built in China. There were no parts besides certain components of the battery in older years that came from China. Okay. It's not a big deal, but it sounds really good and it makes good headlines. I think markets could take some of those headlines and be very excited about it. And that could help pick up some of those cyclicals as well. That could be like a Walmart. It could be like a Dollar General. It could be other retailers that perhaps could be more vulnerable to potential tariff policies. Now, with that said, if you look at the AI Investor Sentiment Survey, that's coming in today bullish at 41.5. Neutral is at 30.9. And bearish is at 27.6. These are really not super optimistic numbers. The 1-year bullish high was 52.9. So you could still go up almost 12% on the bull side, and you still wouldn't be at a 1-year high that we set back in December, late December of 2023. From that standpoint, that's also suggestive of a market that has a lot more upside within it. But again, as I've talked about many times here on this channel, it's not going to be necessarily the S&P that breaks out, because the S&P is really dominated by big tech, and in a broadening out kind of scenario, I would not expect big tech to do very well. I would expect big tech to actually get sold off and the rest of the markets to take that leadership, in which that actually happened today. So depending on what side of the field you're on, whether you are a stock picker or whether you are an index investor, you're going to look at this market in two totally different ways. If you're a stock picker like myself, then you're going to love this. Your portfolio is going to love this, almost no matter which stock you pick, as long as it's not big tech. Well, if you're not a stock picker and you're an index guy, then you're going to say, oh crap, big tech's kind of rolling over here. That's not great. But when you think about the bigger picture, that's exactly what should be happening. And it's happening. So that's great news and very bullish for markets. Eventually, big tech will stop selling off. And eventually, maybe you'll see the cyclicals and small caps chill out a bit. But this is good. This is healthy. This is normal, despite what you might see on Twitter. I know there's a lot of bears out there right now. They're wrong. This is good. Eventually, I do think a growth correction will come, meaning I think Wall Street will get a little concerned about the economic data at some point in early 2025. The first 3 or 4 months of 2025, I'm expecting a pretty aggressive correction, 10, 15% or so. Not necessarily a bear market unless the data is really bad, but some kind of correction will come. And I think that'll be another opportunity to load up on some of the stocks that are doing well right now that have perhaps run too much for your liking. Maybe that's Tesla, maybe that's SoFi, maybe that's Palantir, right? These are stocks I expect will outperform over the coming years. I don't think this is necessarily a 1 or 2 month trade. This is really the start of an outperformance for maybe the next 1 to 2, 3, 4 plus years. Again, as long as we don't have some kind of recession. So let me know what you guys think about this down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.